good afternoon, and welcome to Bulls, Bears, and the Bell, your essential deep dive into making sense of the market action. I'm your host, and today we're really digging into the post-market report for Monday, September 22nd, 2025. It was quite a session. If you're trying to figure out why the market felt so contradictory today, well, you've come to the right place. We'll try and shortcut that for you.
It really was a paradoxical day. It wasn't straightforward, no clear trend, no big runaway rally or major sell-off. Instead, it was just defined by contradiction.
Yep. Yes.
The main indices, they finished slightly down, which, on the surface suggests maybe investors are getting cautious. But underneath all that, you had corporate America acting incredibly bullish, really screaming long-term confidence.
Right. So our goal here today is to unpack that core conflict. We saw the U.S. markets pull back from those recent record highs. The whole day felt like high volatility, lots of indecision. The market's clearly just grappling with news flow that's pulling it in completely opposite directions,
Right.
making it hard to get a clear read.
That's right. And we can really break this down into two major divergences that define the day. First, as you mentioned, that split between corporate confidence and, let's call it, investor caution. So while the big indices like the S&P and NASDAQ faded a bit, that's the public investors maybe taking profits. Stepping back, you had boardrooms making huge bets. A massive wave of M&A deals announced across different sectors. That signals really deep, long-term bullish thinking from company leaders.
So the folks signing the multi-billion-dollar checks are saying full steam ahead, while the rest of us are maybe getting a bit nervous. Look at the sell button.
That's a good way to put it. And that disconnect, it's only amplified by the second big contradiction, the fractured Fed.
Ah, yes, the Fed. Last week, everyone seemed pretty happy, right? We got the September 17th rate cut. The path seemed clear, dovish, kind of unified message.
That unity just evaporated today, completely. Throughout the day, we started hearing these conflicting public statements from key Federal Reserve officials. That clear, dovish signal that really powered last week's rally, it just shattered. And that injected a huge dose of uncertainty, both political and economic, right back into the market. So now we're back to asking, what is the Fed actually planning to do next?
Okay, let's definitely unpack this. We need to understand how these forces were sort of battling it out in the indices first before we get into the individual company stories that really drove the action today.
Yeah, the intraday trading perfectly showed that tug of war. You look at the closing numbers, those small losses, and honestly, they're a bit misleading. The real story was the psychological battle, between the bulls and the bears, right from the opening bell all the way through to the close.
And that roller coaster, it started off pretty negatively, didn't it? Futures were down. The Dow was indicated down like 170 points pre-market. And then right at the open, all three major indices slipped into the red. Looked like investors were maybe reacting to last week's big run, deciding to lock in some profits.
That's the classic move, right? Take some money off the table after a strong run. But what was really fascinating was the market's resilience mid-morning. Those early losses, they were steadily chipped away, and then by early afternoon, we saw this big kind of coordinated rally push through. It actually pushed the S&P 500, the Dow, and the NASDAQ back into positive territory for a while. For a moment there, it looked like they might even extend that record rally. It showed there's still underlying demand, buyers are still lurking.
Yeah, for a few hours, it felt like maybe that corporate confidence we were seeing in the M&A news was sort of rubbing off, overriding the earlier caution. But that momentum just didn't stick, did it?
It didn't. And that's the key takeaway from the day's pattern, I think. The speed of that late session fade. The indices just retreated pretty sharply from those intraday highs and ended up with those modest losses we saw. So the S&P 500, it fell 10.1 points. That's about 0.15%, closed at 6,654.28. The NASDAQ composite, it dropped 24.9 points, or 0.11%, settling at 22,606.59.
Okay, so the final print, it signals deep uncertainty. Not panic, but definitely uncertainty.
Right.
Hold on. If the M&A news was so bullish, so compelling, shouldn't that corporate optimism, that long-term view, be stronger than the Fed's short-term confusion? Why did the Fed seem to win the tug-of-war today?
Well, that's really the heart of it, isn't it? Corporate executives are making these huge M&A decisions based on their outlook for the economy maybe 5, 10 years down the line. Public equity markets, though, they tend to be much more focused on the next quarter's earnings and, crucially, on monetary policy, like interest rates, over the next, say, 6 to 12 months. The fact that the market couldn't hold those midday gains suggests that when investors are faced with immediate, significant uncertainty about the cost of money, which is exactly what the fractured Fed messages created, they start questioning everything. They question the valuations that fueled the rally. They prioritize clarity on what happens in the next 3 months over confidence about the next 10 years. It's about immediate risk.
Okay, that makes sense. Let's look beneath the hood then. What about the market internals? Do they confirm this widespread worry, or was it just profit-taking in a few big names?
The internals definitely confirm the caution. Market breadth was weak, decisively so. Declining stocks outnumbered advancing stocks on both the NYSE and the NASDAQ. The ratios were around 1.43 to 1 on the NYSE, 1.42 to 1 on the NASDAQ. So that tells you the weakness wasn't just isolated in one sector or a couple of mega cap stocks. It was pretty broad-based. A general desire to maybe consolidate positions, reduce risk.
And the volume figures seem to reflect that indecision too, right?
Yeah.
Friday saw a huge turnover after the Fed cut, but today felt more subdued.
Exactly. That subdued volume is another critical piece of the puzzle. It confirms investors weren't really engaging in high conviction buying, but they also weren't panic selling. It feels more like people are just standing on the sidelines, waiting for the next clear signal, which, as we now suspect, is likely going to be Friday's inflation report. It's the textbook definition of consolidation, really.
Okay, now let's talk about the VIX, the CBOE Volatility Index, often called the fear gauge. It ticked up today, went from Friday's close around 15.45 to readings around 15.92, even touched 16 at one point. That's like a 3% gain. A 3% jump sounds a bit concerning.
It does sound that way in isolation, but the context here is absolutely crucial. A VIX reading in the mid-teens, historically speaking, is still quite low, so this rise, it signals caution, not widespread fear. Think of it as the options market pricing in known upcoming risks. They're acknowledging the potential for volatility around Friday's big PCE inflation number and also the uncertainty created by those conflicting Fed speeches we talked about. It's the market saying, okay, things could get bumpy soon, rather than, oh no, sell everything. It really underscores the day's theme. Worry about the unknowable future policy, not necessarily the current economic reality.
All right, let's shift gears then. Let's leave the nervousness of the indices for a moment and dive into what was arguably the dominant story today. This sudden, really remarkable wave of M&A activity, deal-making across multiple sectors. This, as you said, is the definition of corporate confidence in action.
Absolutely. The surge in deals is the powerful counter-narrative to the market's hesitation. And if you connect it to the bigger picture, it's a profoundly bullish signal, right? Corporate boards, they don't just sign off on these multi-billion-dollar deals lightly. It requires real, solid, long-term confidence. We're talking a 5 to 10-year view of stable demand, growth prospects, the whole 9 yards.
And the timing here, it's probably not a coincidence, is it? This spending spree seems unlocked by the Fed's recent move.
Oh, absolutely not a coincidence. That September 17th rate cut, even though it was just 25 basis points, it immediately lowered the cost of borrowing for these huge acquisitions. It makes them more financially viable right now. Lower interest rates mean a lower cost of capital. That makes the expected returns on these newly acquired assets look much more attractive to the acquiring company's shareholders.
Okay, let's walk through some of the big ones, starting with pharma. Pfizer made a massive bet, jumping into the obesity market.
Yeah, this was huge. Pfizer, ticker PFE, announced an all-cash deal to buy Metsera, that's MTSR. They're a development stage company, but focused squarely on that obesity drug market, which, as you know, everyone expects to be just a massive growth area for the next decade or more. A real pharmaceutical gold rush. The base value is significant, $4.9 billion, but it could potentially rise to over $7 billion if certain clinical trial milestones are met, so a big commitment.
And what really caught my eye was the market reaction, specifically to Pfizer, the buyer. Metsera, the target, obviously its stock soared over 60%, which you'd expect, but Pfizer shares also gained pretty solidly, like 1.2% to 1.4% up on the day.
Yeah, that's highly unusual for the acquirer in a large deal like this. Normally, the buyer stock takes a hit, right? Investors worry about overpaying or the costs of integrating the new company or just the strain on the balance sheet. Pfizer's gain here signals that investors strongly endorse the strategy behind the deal. They're essentially saying, yes, getting access to Metsera's obesity pipeline is worth this price tag. They see it as instantly validating Pfizer's future growth path, not as a risky spend, but as a necessary cost to compete effectively in this super hot therapeutic area.
So the market sees this as immediately adding value, not just adding risk or dilution. A strategic necessity.
Precisely. It's a huge vote of confidence in that whole obesity drug sector, basically saying it's worth paying up for entry.
Okay, let's shift over to real estate. We saw a deal aiming to forge a potential new giant there. Compass acquiring Anywhere real estate.
Yeah, another big one. Compass, ticker COMP, agreed to acquire Anywhere Real Estate, HOUS. That's the parent company of some huge legacy brands like Coldwell Banker, Corcoran, big names. This deal was valued at roughly $10 billion, including the debt they're taking on. But the crucial detail here was that it was an all-stock transaction.
All stock. And that detail, that triggered the classic sort of opposite market reaction we sometimes see, didn't it? The target, Anywhere Real Estate, HOUS, its shares rocketed, up something like 45.6% to over 61.6%. Massive premium being priced in.
Huge jump for HO shareholders. But the acquirer, Compass, COMP, its shares absolutely plummeted, down 12% to 16.16%. The market hammered Compass. And the reason goes straight back to those two words, all stock. Unlike Pfizer's deal, which was cash, Compass is paying for this by issuing a ton of new Compass shares.
Can you just quickly unpack that dilution mechanism for us? Why does issuing new shares to pay for something often cause such a sharp drop in the buyer's stock price?
Sure. When a company issues new shares, especially a large amount to fund a big acquisition, it increases the total number of shares floating around in the market. So, for the existing shareholders, their slice of the company pie immediately gets smaller. Their percentage ownership is diluted. And critically, the company's future earnings now have to be spread across this wider pool of shares, meaning the earnings per share, or EPS, goes down. The math is pretty straightforward and often punitive for the stock price in the short term. If you suddenly increase the share count significantly, the theoretical share price often needs to adjust downwards to reflect that dilution. Investors aren't waiting to see if the merger works out beautifully years down the line. They're immediately repricing the stock for that new, larger share count, plus factoring in the risk of taking on billions in new debt, plus the huge challenge of integrating two massive real estate platforms. It's a triple whammy of perceived risk.
That contrast between Pfizer's all-cash deal leading to a gain and Compass's all-stock deal leading to a plunge is just a perfect illustration of M&A mechanics, isn't it?
It really is a textbook example. One deal seen as smart strategy, the other seen as potentially risky overreach, at least initially.
Okay, next up, software and services. We saw private equity stepping in, Thoma Bravo buying PROS Holdings.
Yeah, Thoma Bravo, a big private equity name, acquired PROS Holdings, ticker PRO. They do AI-powered SaaS pricing software. This deal was $1.4 billion, all cash. It really highlights the continued strong appetite among private equity firms for these kinds of enterprise software assets. They see value in taking these companies private. They can work on optimizing operations, maybe make some tough cost cuts, all away from the glare of public markets and quarterly earnings pressure.
And the price looked pretty generous. The offer was $23.25 per share. That's a huge premium, right? Like 41.7% over the previous day's close.
It's extremely generous premium. And naturally, PROS holding shares surged on the news, up about 40.0%, almost matching that offer price. But here's a little twist. The premium was so high, apparently, that an investor rights law firm immediately announced they were launching an investigation. They're questioning whether the PROS board actually got a fair price for shareholders or if they maybe undersold the company's long-term potential.
Wow, so the premium was so big it triggered questions about whether it's big enough.
Kind of ironic, isn't it? But yeah, it just underscores how strong that M&A appetite is right now, particularly from private equity looking for these tech assets.
Okay, and finally in the retail space, we saw a billion-dollar deal. Atlas Holdings acquiring ODP Corp, the parent of Office Depot and OfficeMax.
Right. ODP shares jumped about 33.2% on that news. This move seems like a classic value-oriented play by Atlas Holdings. They're probably not making a huge bet on the future of people buying paper clips in physical stores, in the age of Amazon. It's much more likely they're focused on unlocking the value in ODP's considerable real estate holdings, and especially its large, established business-to-business B2B supply operations. That's probably where the real hidden value lies in that legacy company.
Okay, so we've established this theme. When the big macro signal from the Fed is fractured and confusing, the market kind of breaks apart. Individual company-specific news becomes much more important in driving stock prices. Let's look at some of those other micro-catalysts, the specific stories that made winners and losers today beyond the big M&A headlines.
Absolutely. When the main indices are basically treading water like they were today, the real action, the big percentage moves, it's all happening in these individual stock stories. It really determines whether your portfolio felt the heat or caught a nice updraft.
So starting with some gainers that weren't eminent targets. Diginex Limited, DGNX, that jumped almost 28%. What was going on there? Seemed purely technical.
Yeah, that looks like a classic technical sentiment-driven move. The catalyst seems to be a stock split they did earlier in September, an 8-for-1 split. Now, a stock split doesn't actually change the fundamental value of the company, right? It just cuts the pie into more smaller slices. But the resulting lower per share price often makes the stock seem psychologically more accessible, maybe more affordable, especially to retail investors. It can boost liquidity, attract more speculative interest, and sometimes you get these sharp upward pops, particularly in stocks that end up with a lower price tag after the split.
Interesting how psychology plays such a big role there.
Yeah.
We also saw commodities having an influence. Endeavor, Silvercore, EXK surged nearly 15%.
Yeah, that was a direct consequence of silver prices just going on a tear, hitting a 14-year high, touching $44 an ounce. That kind of move lifts all boats in the silver mining sector. And we also saw, interestingly, broad rallies in a bunch of Argentine financial stocks. BBV, Argentina, Banco Macro, Grupo Financiero Galicia, all up significantly. That reflects very specific positive regulatory news or economic sentiment within Argentina itself. Again, it shows when the overall U.S. market lacks clear direction, capital tends to flow into these more specific geographic plays or commodity-linked stories where there is a clear catalyst.
Okay, let's flip over to the loser side now. Here, it seems like corporate debt issues and policy risk were the big drivers. The Brazilian conglomerate Cosan SA, their ADR, CSA, absolutely plunged today, down almost 22%. Ouch.
Yeah, a massive drop. And this was a direct, severe market reaction to what we can call a classic dilution disaster. Cosan announced plans for 2 large primary public share offerings. Now, they intend to use the cash raised to repay financial debts, which, fundamentally is a good thing, reducing leverage on the balance sheet. However, the key word here is primary offering. That means the company is creating brand new shares and selling them to new investors. Unlike a secondary offering where existing shareholders sell, a primary offering fundamentally increases the total number of shares outstanding. And that dramatically dilutes the ownership stake and, crucially, the future earnings per share, EPS, for every single existing shareholder.
So the market is saying the pain of that dilution outweighs the benefit of paying down debt.
Exactly. The severity of that 21.8% drop shows the market did the math quickly and decided that the loss of ownership value for current holders was far more significant than the benefit of a cleaner balance sheet.
Wow. That's a really stark reminder that how a company finances something, even something positive like debt repayment, matters immensely to current shareholders.
Absolutely. The financing mechanism can be just as important, if not more so in the short term, than the purpose of the financing itself.
Okay, then we also saw a pretty significant policy-driven sell-off across a whole sector, IT services firms, particularly those relying heavily on foreign workers coming to the U.S.
Yeah, this was immediate, and it was pure headline risk driving this. The catalyst was news reports, specifically mentioning a potential presidential proclamation aiming to overhaul the H-1B visa program. And the most alarming detail reported was the potential inclusion of a really steep fee, maybe $100,000 per H-1B applicant.
Whoa, wait. $100,000 per applicant. That sounds astronomical. How does that compare to what companies pay now? Why would that immediately wipe billions off the market caps of these big IT firms?
It is astronomical. To give you some context, the current standard H-1B filing fees, depending on company size and a few other factors, typically range somewhere between, say, $1,700 and maybe up to around $8,000 per application, give or take. Jumping from that level to potentially $100,000 per person fundamentally shatters the business model economics for many of these IT consulting firms. Their entire model often relies on accessing large pools of skilled foreign workers on visas, allowing them to offer competitive pricing to their U.S. clients. If the cost of bringing in each worker skyrockets like that from a few thousand to $100,000, well, their operating margins get squeezed incredibly hard almost overnight.
Okay, that explains why the reaction was so swift and sector-wide then.
Precisely. We saw shares of the big Indian IT giants, companies like Tech Mahindra, TCS, Infosys, all fall sharply, maybe 2.5% to 3%. And it hit their U.S.-listed peers too, like Zenzar, Emphasis. The market is basically pricing in the fear of potentially massive margin compression driven purely by a possible regulatory policy change. It just overrides everything else for that sector today.
And finally, on the losing side, we had another headline risk story hitting the consumer health stock Kenvue, the maker of Tylenol. KVUE dropped about 5.6% early on.
Yeah, and that drop seemed entirely driven by a specific report in the Washington Post. The report alleged that officials in the Trump administration were considering plans to publicly link Acetaminophen, that's the active ingredient in Tylenol, to autism, and potentially issue warnings against its use by pregnant women.
Just the report of a potential plan caused the stock to drop that much.
Exactly. Kenvue was being punished today purely based on the potential for a future negative policy announcement or public health warning. It creates this huge cloud of uncertainty, a massive risk premium that the market felt it had to price in immediately, even before anything actually happened.
These examples really drive home that fragmentation point, don't they? Company-specific news, whether it's M&A, dilution, or these policy threats, it just absolutely dominated individual stock moves today.
Okay, let's pivot back now to the biggest macro factor looming over everything, the Federal Reserve. We came into the week feeling pretty good, right? Riding high on that September 17th rate cut, the first one of 2025, took the target range down to 4.04.25%. And the dot plot that came with it seemed to signal maybe two more cuts were still possible this year. That felt like a clear path forward.
Yeah, that relatively clear dovish consensus was definitely the wind beneath the market's wings last week. But the foundation for that rally just crumbled today. It crumbled because of this stark, very public fracture appearing within the Fed itself. The question suddenly isn't just if they'll cut again, but why they would cut. And it's clear there's a significant internal debate now spilling out into the open. Let's detail that conflict, because the two main voices we heard today seem diametrically opposed. On the one hand, the more hawkish side, we had Atlanta Fed President Raphael Bostic. He basically said he sees little reason to cut rates further for now.
Right. Bostic represents that voice of caution, really focused on inflation still being persistent. He's looking at the labor market, which is still pretty tight, looking at services inflation, and essentially saying, hold on, we got the first cut done, but the data doesn't scream that we need to rush into more easing just yet. He seems worried about reigniting inflation, thinks the Fed's job isn't quite finished, and maybe risking that is too high a price to pay right now.
Okay, and then in direct opposition, we heard from the dovish side. Newly installed Fed Governor Stephen Miran. He apparently argued for steep rate cuts.
Exactly. Miran clearly falls into the camp that's more worried about the labor market slowing down, potentially risking a recession. He seems to believe the Fed should act more preemptively to head that off. Remember, he actually dissented last week, arguing for a bigger 50 basis point cut instead of the 25 we got. So his comments today show a deep philosophical concern that maybe the Fed is moving too slowly and could cause unnecessary economic pain, particularly in employment.
Wow. So having this very public disagreement between a regional Fed president like Bostic and a governor like Miran, that's got to be hugely destabilizing for market expectations, right? The market seemed pretty comfortable pricing in those two potential extra cuts this year. How does this lack of a unified message, this leadership vacuum, specifically change how investors have to approach things right now?
It fundamentally shifts the game. It forces investors to pivot from trading based on the Fed's expected path to trading based on the incoming economic data. The market now has to assume that those two additional cuts weren't baked in the cake anymore. They're conditional, highly conditional. This makes every significant data release, but especially Friday's PCE inflation report, exponentially more important, because that data will now essentially act as the tiebreaker in this internal Fed debate. Instead of relying on Fed guidance, the market now has to distrust the guidance and focus almost purely on the raw data inputs to figure out which side Bostic's caution or Miran's urgency is likely to win the day at the next FOMC meeting.
Okay, so if the Fed signals are confusing, let's look at how the Treasury market reacted. That's often seen as the smart money. Interestingly, the yields themselves didn't move dramatically today. The 10-year Treasury yield kind of held steady around 4.133%. And the 2-year yield, which is usually more sensitive to near-term Fed policy shifts, was also pretty stable, around 3.60%. What's going on there?
You're right, the absolute levels didn't jump around much. But the key is to look at the relationship between those yields. What we continued to see today was the spread, the difference between the 10-year yield and the 2-year yield widening. This phenomenon, especially when it happens after the Fed starts cutting rates, is known as a bull steepener of the yield curve.
Okay, bull steepener. That sounds pretty technical.
Yeah.
Can you break that down? What exactly is it, and what is the bond market maybe telling us with this steepening that the equity market seems to be struggling with?
Sure. Think of the yield curve as just a line plotting interest rates, yields, for bonds of different maturities, short-term like 2 years, out to long-term like 10 years or 30 years. When the curve steepens, it just means the gap between those long-term yields and short-term yields is getting bigger. A bull steepener specifically happens when short-term rates fall faster than long-term rates. And that's often triggered when the Fed cuts its policy rate, which most directly impacts the short end of the curve, like the 2-year yield.
Okay, so the 2-year reflect the immediate Fed action, and the 10-year is looking further out.
Exactly. The 2-year yield is pricing in expectations for Fed policy over the next couple of years. The 10-year yield reflects much longer-term expectations about economic growth and inflation. So this steepening curve, this bull steepener, it suggests bond investors are holding one of two competing, quite nuanced views right now. And maybe both are playing a role.
What are those two potential interpretations?
Okay, interpretation one is actually a sign of growth optimism. Bond investors might believe that the Fed's rate cuts, starting now, will eventually succeed in stimulating stronger economic growth down the road. Stronger growth often leads to higher inflation eventually. So they're demanding a higher yield, a higher interest rate to lend money for 10 years because they anticipate needing more compensation in a potentially more robust, maybe more inflationary future economy.
Okay, so that's the bullish part of the bull steepener. Belief in future growth.
Right. But interpretation two is a bit more skeptical, focused on sticky inflation. Bond investors might believe that even with cuts, inflation is going to remain stubbornly above the Fed's 2% target for a long time. If they believe that, they don't think the Fed will be able to deliver that deep cycle of rate cuts that the doves like Governor Murin are hoping for. They think inflation will prevent rates from falling too far, especially at the long end. So either way, whether it's optimism about growth eventually leading to inflation or skepticism about inflation falling quickly, the bond market seems to be signaling that long-term borrowing costs might stay relatively elevated, or at least won't fall as dramatically as short-term rates might initially. It's a subtle pushback against the idea of a perfect soft landing with rapidly falling inflation that maybe the equity market was hoping for after the first cut.
That's fascinating. So the stable yield numbers were actually masking some pretty complex signaling underneath. Okay, let's quickly touch on commodities and currencies before we wrap up.
Sure. The lower interest rate environment, or at least the start of a cutting cycle, clearly boosted safe haven assets that don't pay interest. Precious metals had a strong day. Gold traded up near its record highs, around $3,757 an ounce. And silver, as we mentioned, surged to that 14-year high, hitting $44 an ounce. Lower yields reduced the opportunity cost of holding non-yielding metals, making them more attractive.
But contrasting with that, energy prices were a bit soft. West Texas Intermediate crude oil actually declined a bit, settling around $62.19 a barrel.
Yeah, that slight drop in oil might reflect some lingering concerns about the strength of global economic demand. It could be a sign that while the U.S. corporate sector feels confident, judging by M&A, there are perhaps still worries about growth in other parts of the world. Meanwhile, the U.S. dollar index, DXY, was pretty stable. It seemed caught in a tug-of-war itself, feeling downward pressure from the potential for future U.S. rate cuts, but also getting some support from its traditional role as a safe haven asset whenever uncertainty like this pops up.
Okay, so we've really navigated through a day defined by, I think the word is fragmentation. We had caution showing up in the broad indices. We had massive bullish confidence evident in that corporate M&A spree. And then we had this profound internal fracture revealed at the Federal Reserve. Quite a mix.
That's the perfect summary. And the primary conclusion for you, the listener, really has to be that the market just isn't moving as one cohesive unit right now. It's not trading on broad macro themes. Instead, micro-level, company-specific news, whether it's a huge M&A premium, a painful dilution announcement, a scary policy risk like that H-1B headline, or a spike in silver prices. That stuff was far more powerful today in determining individual stock returns than any single overarching macroeconomic trend.
So this kind of environment, it really rewards doing your homework right. Deep bottom-up analysis of individual companies probably pays off more than trying to make broad top-down bets on the whole economy.
Absolutely. It favors investors who are digging into the details, looking for clear value, pricing specific risks accurately. It's much harder to just ride a general market wave when the underlying currents are so confused, especially when central bank guidance, which used to be a major driver, is suddenly unreliable, as we saw today.
And with the Fed now showing this deep internal disagreement between the hawkish Bostic and the dovish Mirren, the market's focus, you said, shifts decisively. There's one single event this week that everyone's waiting for to potentially break the tie.
That's right. All eyes are now laser focused on Friday's release of the August Personal Consumption Expenditures Price Index, the PCE report. This is the Fed's preferred measure of inflation, the one they watch most closely. So the stakes for this report, given the Fed's internal split, could not be higher right now.
Okay, and what are the expectations? Consensus estimates are for headline PCE to tick up just slightly, maybe to plus 2.7% year over year, while core PCE, which strips out food and energy, is expected to hold steady at plus 2.9%.
Exactly. Now think about the scenarios. If we get a hot reading anything significantly higher than those expectations, it would immediately validate Raphael Bostic's hawkish caution. That kind of number could force the market to quickly price out one, or maybe even both, of those remaining rate cuts they were hoping for in 2025. And that could easily trigger a significant sell-off in stocks, as valuations would need to adjust to the reality of higher for longer interest rates.
And the flip side, a cool reading.
A cool reading, something lower than expected, would provide massive ammunition for Governor Murin's dovish case. It would signal inflation is behaving, easing the pressure. That could instantly reignite the rally we saw briefly last week as hopes for more rate cuts would surge back. The market is basically holding its collective breath until Friday morning.
And besides PCE, there are a few other data points investors will be watching this week too, right? Things like housing data, manufacturing surveys.
Yeah. Yes, definitely keep an eye on new and existing home sales figures, the flash PMI surveys, which give us a read on manufacturing and service sector health, and also the final print for Q2 GDP, just to confirm the recent economic picture. And we also can't forget earnings season is still trickling in. We get key quarterly reports from influential companies like Micron, MU, in the tech space, and Costco, COST, for the consumer side. Their results and outlooks will provide really vital, real-time clues about whether that corporate confidence we saw in M&A is holding up, or if maybe the market's more cautious mood is actually the more accurate reflection of current business conditions.
Okay, well, I think we've successfully navigated the maze that was the September 22nd market report. Hopefully, you now have a much clearer framework for understanding these conflicting forces, the push and pull between long-term corporate vision, short-term investor anxiety, and a central bank that seems fundamentally divided at the moment.
And maybe just one final thought to leave you with, something to mull over as we head towards that crucial PCE report on Friday. Consider this really remarkable disconnect we spent so much time on today. You have corporate leaders, CEOs, and boards committing billions of dollars to M&A deals. That shows incredible confidence in the long-term economic outlook, right? We're talking 5, maybe 10 years out. Meanwhile, the public equity market seems almost paralyzed by short-term uncertainty, specifically uncertainty about whether the Federal Reserve is going to cut interest rates one more time, two more times, or maybe zero more times in just the next 3 months. What does that massive split between long-term corporate optimism and intense short-term monetary policy anxiety really tell you about the underlying health of the real economy versus the powerful psychological grip that Fed policy holds over market sentiment? It's a fascinating question, something to think about.